Let's talk about silver. For so many of us, it's been a long, long wait. But imagine for a moment that the day has finally come. The price has exploded, more than doubling in less than a year, hitting a monumental $64 an ounce. You feel validated, vindicated. But right at that very peak, at the moment of maximum excitement, a siren starts to blare. Every algorithm, every talking head, every technical chart starts screaming just one word: sell. It's a signal that has a near-perfect track record of calling major market tops for almost half a century, and ignoring it feels like pure insanity. But what if it's not? What if the real madness is listening to that siren? What if this signal isn't an ending at all, but a beginning?
Welcome back to the Bullion Signal Podcast. This is the channel where we cut through the noise to analyze the macro forces shaping our world, especially when it comes to gold, silver, and the preservation of your wealth. If you're new here, make sure you hit that subscribe button, because today we are diving into one of the most critical and confusing signals I have seen in my career. We have a technical indicator that is flashing a 5-alarm fire, a historic warning to get out of the silver market. And yet, at the exact same time, a little-known historical precedent suggests this could be the exact opposite. It could be the starting gun for a move that will dwarf everything we've seen so far. So which one is it? A warning or a starting gun? Let's figure it out together.
All right, first, let's get grounded in the facts. We're looking at a silver price of $64.30 an ounce. Now, you have to remember, this year started with silver hovering right around $30, so we're talking about a gain of over 110%. That is not a slow, steady climb. That is a violent, explosive repricing, the kind of move that gets everyone's attention. The momentum, well, it feels absolutely unstoppable. And believe it or not, that's exactly where the trouble starts for most traders.
Now this is the number that is causing absolute panic on trading desks all over the world: 87. That is the current reading on the Monthly Relative Strength Index, or RSI. Now, to give you some context for just how extreme that is, this reading means silver is the most overbought it has been in 45 years. You literally have to go all the way back to the historic, infamous blow-off top in January of 1980 to find a number this high. So in the world of technical analysis, this isn't just a red flag, this is a code black emergency. It's the market's equivalent of a 5-alarm fire drill.
Okay, so before we try to challenge this signal, it's absolutely crucial that we understand why it's so feared. This isn't just some vague feeling. The fear is based on decades of data and painful experience. There are very sound, very logical reasons why almost every professional trader on the planet sees this signal and immediately thinks sell. So let's do them justice. Let's walk through the bearish case first.
For anyone who might not be familiar with this tool, the RSI is basically like a speedometer for an asset's price. It doesn't tell you the price itself, but it tells you how fast and how aggressively the price has been moving. When a price shoots up really fast, the RSI goes up. Think of it like a rubber band. The more you stretch it in one direction, the more likely it is to snap back violently. The RSI tells you just how stretched that rubber band is. And right now, that gauge is off the charts.
Here's a look at how professional traders see the world through this lens. Once the monthly RSI reading goes above 70, they get nervous. They call that overbought. That's the first warning sign. When it crosses 80, well, that's a red alert. At that point, people are actively looking for the exits. But a reading of 87, that's not even on the map for most. It's what you might call unicorn territory. It's so rare, so far outside the statistical norm, that for many automated trading systems, it's not just a signal to sell your long positions. It's an aggressive signal to go short, to place bets that a massive crash is imminent.
And this sentiment is everywhere. This quote really sums up the message you're hearing from the entire financial ecosystem. It's the blinking alert on your broker's platform. It's the urgent panic tone of the experts on financial news. And it's the cold, hard logic being executed by billions of dollars in algorithmic trading funds. The message could not be more clear. You had a fantastic ride, but don't get greedy. Take your profits and run, because this party is officially over.
You know, this fear isn't just theoretical. It is rooted in very recent, very painful memory. All you have to do is look back to 2011. Silver went on an absolutely spectacular run, almost touching $50 an ounce. The hype was incredible. And guess what? The RSI was flashing extreme overbought readings, just like we're seeing today. And what happened next is seared into the minds of an entire generation of silver investors. The price didn't just correct, it completely collapsed. It fell by nearly 70% over the next few years, trapping anyone who bought near the top. That memory is a powerful, powerful motivator.
And as if the technical picture wasn't scary enough, the macroeconomic headlines seem to be telling the exact same story.
We have stubbornly high inflation, which means the Federal Reserve is forced to keep interest rates high and money tight. That's usually a headwind for metals. We're seeing reports that China's electric vehicle boom, a huge source of silver demand, is starting to slow down. And all the while, the whispers of a global recession are getting louder and louder. So you see, on the surface, the case looks open and shut. The technicals and the fundamentals are all pointing in the same direction, down.
Okay, we've looked at the bear case. We've given it the respect it deserves, but now we're going to pivot. Because if you only look at the last 10 or 20 years of data, you're missing the most important part of the story. We are going to travel back in time to a period that serves as an almost perfect blueprint for what we are seeing today. An era that looked and felt remarkably similar, where the exact same signals flashed, but where the outcome was so radically different that it forces us to question every single assumption we just made.
Just look at the parallels between the 1970s and our current environment. They are absolutely uncanny. Both eras were defined by three key things. First, a massive monetary shock that shook the foundation of the global financial system. In the 70s, it was the U.S. leaving the gold standard. Today, it's the beginning of a global de-dollarization movement. Second, a terrifying inflation crisis. In the 70s, it was the Nixon shock inflation. Today, it's the aftermath of unprecedented pandemic stimulus. And third, a major geopolitical shock. Back then, it was the oil embargo. Today, it's a world fractured by multiple conflicts and supply chain disruptions. The backdrop, the very feeling in the air, it's hauntingly familiar.
Now this is the punchline. Right in the middle of all that chaos in the 1970s, silver started to wake up. As it broke out above $3 an ounce back in 1973, guess what happened? Its monthly RSI spiked to an extremely overbought level, a reading that was identical to the very signal that's scaring everyone today. You can imagine the traders back then looking at their charts saying the exact same thing. Get out now, the party is over. And in following that signal, they made one of the most expensive mistakes of their entire careers.
Because silver didn't crash, it didn't even pause. In fact, it seemed to use that sell signal as a launch pad. In the 3 months after that extreme RSI reading flashed, the price of silver didn't go down. It skyrocketed another 120% higher. Let that sink in. The very signal that screamed bubble was in reality the starting gun for the most aggressive part of the move.
And that incredible surge was just the beginning. That was just the first leg of a much larger journey. Over the course of the entire secular bull market that started right there in 1973, the price of silver multiplied 16 times over. The lesson here is absolutely vital. In major, paradigm-shifting bull markets that are driven by fundamental crises, the word overbought takes on a new meaning. It doesn't mean a top is near. It means the big institutional money is just starting to wake up and get in.
Look, a historical parallel is a powerful guide, but it's not enough on its own. We have to connect it to the hard, cold facts of today's market. And when we do that, what we find is truly remarkable. The fundamental case for silver today is not just as strong as it was back in 1973. It is, by almost every objective measure, structurally and undeniably stronger.
To understand why, you first have to look at where silver demand actually comes from in the 21st century. A massive 60% of all silver consumed every year is for industrial applications. This is the single biggest difference between today and the 1970s. Back then, silver was still seen primarily as a monetary metal, a smaller cousin to gold. Today, it is one of the most critical and indispensable industrial commodities on the planet, with a rock-solid floor of real-world, non-negotiable demand.
And we're not talking about just any industrial demand. We're talking about the core technologies that are literally building our future. You cannot manufacture high-efficiency solar panels without silver. You cannot build electric vehicles without silver. You can't build out the 5G networks that connect us or the massive data centers that power the artificial intelligence revolution without silver. This demand isn't optional, it's not a luxury, it is at the absolute heart of the green energy transition and the digital age.
So what happens when you combine this absolutely explosive, non-negotiable demand with the simple realities of getting metal out of the ground? You get what's called a structural deficit. And it's not a one-time thing. For 5 years in a row now, the world has physically consumed significantly more silver than all the mines on Earth have been able to produce. This isn't a projection or a forecast. This is a documented physical reality. We are using more than we are making year after year.
And the scale of this problem is just staggering. Right now, that annual shortfall between what we use and what we mine has grown to 117 million ounces. every single year, the world is digging into its above-ground stockpiles to make up the difference. We're draining the warehouses, and that can't go on forever. This is the underlying fundamental force that is pulling, stretching, and dragging the price higher, completely independent of what some short-term chart might be telling you.
Okay, so let's bring this all back together. We started this discussion with a terrifying technical signal that has a 45-year track record. But we've established that we are not operating in a normal market. We are in a period of macro upheaval with a stunningly accurate historical parallel. And on top of that, we've shown that the fundamental supply and demand picture for silver today is even more bullish than that historical precedent. This new information forces us, it compels us, to rethink what that signal really means.
And so we have to ask the core question again, but now armed with all this new context. Is silver truly overbought at $64 an ounce? Or is that overbought signal simply the sound of a coiled spring finally snapping? Is it the sound of the market waking up to years of a profound physical deficit and the relentless debasement of our currencies? The lesson from the 1970s suggests it is absolutely the latter.
So let's just run a quick thought experiment. I'm not making a prediction here, just applying history. What happens if this time really does rhyme with the 1970s? Well, if we take that initial 120% surge that happened after the 1973 sell signal, and we apply it to today's $64 price, it gives you a potential short-term target of around $141 per ounce. Now that sounds like a shocking number today, but it is perfectly in line with the historical blueprint for this exact setup.
And if we dare to look at the bigger picture, if we consider the full scope of that 1970s bull market, that incredible 16-fold multiplication in price that started from that very first sell signal, applying that same precedent to today's market points to a long-term potential that is far beyond what most people can even begin to imagine. Again, this isn't a forecast. It's a data-driven illustration of what is possible when a market breaks free from its old constraints and enters a true, fundamentally driven secular bull run.
And that, right there, is the ultimate takeaway from all of this. That extreme, terrifying RSI reading is not a warning that the party is over. It is a confirmation that the real party is just getting started. It is the market's way of screaming that the underlying fundamental forces of supply, demand, and monetary debasement are so incredibly powerful that they are literally breaking the old models and short-circuiting the old signals. This is the market telling you that a major historic repricing event is underway. And the only question you have to ask yourself is this: will you listen to the false warning, designed for a world that no longer exists, or will you recognize the true confirmation of a new era beginning? The choice is yours. Thank you for tuning in to the Bullion Signal Podcast. If you found this analysis valuable, please hit that like button, share it with someone who needs to hear it, and make sure you're subscribed for our next update. And as always, remember that this content is for informational and educational purposes only. It is not financial or investment advice. You should always do your own research and take full responsibility for your own financial decisions. We'll see you next time.